Okay, good afternoon, everyone. Welcome to the weekly Take on the Market. Today is Friday, August 22nd. It is 1:20 Pacific Standard Time. Market closed 20 minutes ago. I will be your host. My name is Scott St. Clair. I'm the manager of the Premium Product Group here at Investors Business Daily. Let's look at the disclaimer. Please take a moment to read this. It's very important. I know it's a headache for you guys. It's a headache for us, but um, we're not licensed, so we want to protect the integrity of these videos, the content that we provide. And I've mentioned it before, but it's worth re-mentioning in case you're new. One of the great perks of working at IBD is being able to be involved in the markets, having skin in the game like yourselves. Okay, so we will follow the same routine. Market indices. Um, we'll. I don't know. I'm kind of hemming and hawing on how to proceed with good trade, bad trade, because I have some stuff that we did from the virtual summit on Saturday that I thought was pretty interesting that I'd like to share. The virtual summits are not recorded, and this is, so this would be a chance for a lot of you that might not have had a chance to go to that to see a little snippet of what the virtual summit is like. So I'd like to share that. We'll do the quote of the week. So this might be a long one. And on that note, these videos are they're just like an ancillary let's feature of a market surge subscription. You're not these are not behind a paywall. We put these on YouTube for people to watch. So how this all started was we used to just do once a month we would do the Stay in Step webinar. Me and Arusha did it for a long time, and now Arnie and Harold are the co-hosts of that. And one time, I don't remember what happened, but something crazy happened in the market, and we thought, man, it's a shame we can't do a Stay in Step video and talk about the market. And then we're like, well, why can't we? Why don't we just do a weekly take this one instance? And then it kind of fed on itself, so it became a weekly thing. And I know I mentioned last week that it might become like a bi-weekly thing. I think we'll meet you somewhere in between. There won't be more than 3 of these a month, that's for sure. With the week that Arnie and Harold do theirs, we won't do it the Take on the Market. And if the market's quiet or something comes up and we can't do one, apologize. I got some feedback from a lot of you, good, bad, and different. I really enjoy these videos. Some people felt like I was a bit rushed in some of them. Fair enough. This is off the cuff. Everything I do here is off the cuff. I prepare some slides and then I just hit record. And I like that better. I think it brings more authenticity to it. I haven't prepared or practiced or anything of that nature. So I guess maybe that will, sometimes I can kind of lose my train of thought or I guess maybe it seems like I'm disinterested, but I really enjoy these videos. Honestly, I really do. I think it's one of the perks of my dates, well, week to week. So appreciate your feedback. You're welcome to send us the feedback that you with the email that we get. So hopefully I kind of address some of the questions about the frequency of this video. And I know a lot of you told me it's like an important part of your routine, and that's awesome. I really was glad to hear that. But it's not, it's not part of a market surge subscription, for lack of a better term. Okay, so let's look at a couple slides. This is interesting. The Berkshire Hathaway's performance versus the S&P, and you can see it tends to underperform in really strong bull markets, and which tend to lead to really bad bear markets, which is the downside to really strong bull markets. So we are in kind of one of those periods, and the problem is the timing of it. But I find it interesting. I remember didn't know that much about it, but I remember Buffett being on the cover of, I think it was Fortune or something like that, where it basically felt like he had lost his way because he had missed, the great internet boom. And so and then of course, that ended his performance really increased from there. So I think the message here is this: we're in a big bull market for sure. That's pretty plain to see most days. Some days you get these little spots of bother for a day, a week, maybe even a month sometimes, but the market tends to come back. One time it won't come back. And so you have to have some type of plan, I really truly believe, to protect yourself in that kind of scenario. It might be a week from now, it might be a year from now, it might be 10 years from now. And that's really what makes it so difficult is because you might get tripped up and think, oh, this is the signal, protect yourself, and then the market rights itself. And you do that over and over. And that's kind of what I do. And then you just start to think, what's the point? Well, there's the point to it. Eventually you'll be glad that you do that. I thought this was very interesting. This came across my YouTube feed, and B of A's Chris, I don't even want to pretend to pronounce his name, but he says investors should be buying on this weakness. Well, he was right. The market had a tremendous day today, so he was right. But I just find it a bit amusing that the weakness point, because what was the market? 2-3 days off of all-time highs. So there just isn't any appetite for a larger pullback, which is why I think if a larger pullback were to transpire, it could get pretty ugly pretty fast. So that's these two kind of slides just reinforce my feelings that it's a bull market. You want to treat it as such. I'm in looking for ideas. If I have an idea, I honestly 98% of the time I have an idea. I don't even really even know or care or even look at what the S&P or the NASDAQ is doing. I'm just going to go buy that idea. But I think it's a chicken and egg. If the market's really bad, that idea might not show up so positively in the way I view it. Or if the market's really bad, the idea will fail. And that's what my stop loss is designed to do, is to protect me in that regard. All right, so let's pull up the indexes. I'm going to turn off my camera. And here's the S&P, and you can kind of see I drew these trend lines. We're in this channel, and so we're basically in the middle. And today was a really strong day. Let's go to the index. I get the Jackson Hole comments from Jerome Powell. Obviously, we're the catalyst, and a really strong day. So we're 1, 2, 3, 4 days off the high, and give it a day or two. It looks like we'll be back at new highs. NASDAQ, so not quite as close because it sold off a little bit stronger. So you could be setting up for some kind of divergence. The divergence would be where the S&P makes a new high, but the NASDAQ does not, and then rolls over. That would be kind of a negative signal if you're looking for maybe some fly in the ointment, some kind of signal to make you think about protection mode. But other than that, I think if you follow the indexes, and a lot of people do, it's I drew that kind of here. It's in an uptrend until otherwise noted. Keep it pretty simple. Look at the volume came in pretty strongly. You're declining on lighter and lighter volume. The volume came in pretty strong today so far. So I think like if you like an idea, I think you take it. IBD had, I think coming in, we were a little bit cautious, and we took it instead of 80 to 100, which is the max exposure. We went 60 to 80, which is one notch down. And I'd be fairly certain they'll probably raise it back to 80 to 100. And that's the same way that like I would trade if I had to trade this market. I would be cautious, I would be protected, I would be lightly invested there, and then getting back in if I wanted to. And you're going to do that over and over, and you're going to wish you hadn't. until you're glad you did. Something like this, for example, or something like this. It's going to allow you to protect that, but you're going to get, you're going to get a few nicks along the way. You're going to get some false signals along the way that aren't any fun. Ethereum went bananas today. Oops, I know what I need to do. Bear with me here. I need to turn off that. I figured out, somebody emailed me and then I figured out what I was doing wrong with that. I was looking at fund ownership because there was a stock I was trying to see. So I need to hide this button. So the reason it keeps popping up like this is because I have the show fund ownership button clicked. So I don't want that to pop up. So if I go from stock to stock, it should stop doing that now. Perfect. Okay. So Ethereum, and if you're like me, you want the leverage. You got the double one. Look at the double one is up 30% today. Bitcoin bounced off the 50-day. What did gold do? It's kind of still in this space, although the relative strength is I don't know. I mean, it sort of borders on poor. I think I could say that pretty fairly that it's bordering on poor. So risk on was the message today based on, I don't even honestly know what Jerome Powell said. I can assume what he said, but I didn't even know there was a Jackson Hole until about 4 days ago, that this was a thing that was possibly coming up. I just don't want to pretty my little self with it. I just don't want to be bothered by it. I was in like 3 or 4 names long, and one was Chinese and one is Singaporean. And when I heard about the Jackson Hole and the way the U.S. market was acting, I just was like, I'm not sure that these even matter. Now, if the U.S. market comes unglued, unfortunately, everything matters and they'll probably all go down. But unless it's really, really bad, they just kind of march to the beat of their own drum. And it's what they kind of did. And we'll look at those in the stock segment. So I don't really have a whole lot more to say about the indexes. So let's go to good trade, bad trade. And so the good trade was Futu. I apologize if 2 weeks ago, I don't believe I did. Did I do Futu? Gosh, I should have looked. See, this is what I mean. This is where it's, what stocks did I do? Last time. Gosh, I'm going to be embarrassed if I did Futu. But anyways, we're going to run with it at this point. I'm too deep into the video. I'm not re-recording. So I think the reason I remember that maybe I did is because I remember going through the steps. I bought there, sold there, bought back there. So let's do an update if I did. So it comes out with earnings and I tend to hold into earnings. I might reduce my position if need be, but you're never going to have a big winner if you don't hold into earnings. Now you're going to have some losers along the way, like ARM Holdings for me was one, but you have to hold into earnings, I think, to have a big winner. Now, the earnings were really, really good, up 102%. Look at these numbers. These numbers are so powerful. Now, I know it's Chinese, and we could go down that rabbit hole another time, but I mean, the margin is 85%. Revenue, it's just very compelling to me. And so I had a position, and let's go to the intraday because so in the morning, is this it right here? I believe that is August 20th. Let's make sure. Yeah, okay. It's very interesting action. So in the morning, the stock was like up here in the pre-market. I think it was a lot higher. And I actually was doing some trimming because that's what I do. And then it just opened and then flushed down. And I was like, oh boy, I'm sure glad I did some trimming. But then it started to come back and came back. So I bought back my position. And that was just what happens. I mean, I tend to sell on gap ups and I didn't want to get out of all of it because that's what happens. Sometimes you get out of all of it and then you're not there for the big win. But also the market, I feel like on August 20th, I can't remember if it was a bad day so the market was pretty poor that day too. So there were some factors that influenced me, that because I think I had some other stocks that weren't acting all that good, which will influence me. Unfortunately, it will. So great day, beautiful day, a turnaround volume. So now you got the earnings out of the way. Now I can really start to increase the position, and I'm just going, really pedal to the metal as best that I will, or as most as I will, for a foreign, Chinese stock. If this was Charles Schwab, I might go to much larger position, but I had a fairly good position, and it's big enough that you have 20-30% in a stock. The way this moves 5-6-7% a day, it can move the needle if you get it right. So I was able to withstand that, held it pretty well, up 3 days in a row here today. So I finally have trimmed a lot of it, and I have very little left, maybe 10-15% of the total position that I had. But remember, it's gone from roughly 150 to 190. So it's moved 40 points in 2, 4, 6, 8, 10, 12, about 14 sessions. It's moved almost 27%, 14 sessions. So does it have to pull back? No. Could it pull back? For sure. Would a pullback be out of the ordinary? Definitely not. Do I want to sit through a pullback? No, because I'm not very good at them. I need to be light. And if it does do something like this, like it did here, like that, I can stand it, and then I can add as it starts to come back up out of it. I can rebuild my position. So I've handled this one actually very well. I've handled this one. I never handled it perfectly, but like if I was to give my grade on a 0 to 100, I think this would be a 91, 92, something like that. I've done it, handled it really well. I think the only thing is I wish I had more size because I had a lot of conviction in it. But then I also kept falling back to the, it's Chinese stock, geopolitical risks, et cetera, and always kept me from having like a, 30-40% position, which I don't do that often anymore, but I will do that. I think the last, for example, last stock I had more than a 30% position in was like Nvidia. So something like that, I can have that type of size in it because of the liquidity and the institutional sponsorship, et cetera. So this doesn't quite fit into that bucket, but I was pretty convicted with the earnings, the sales, the quality of the relative strength, the way the stock was acting, and I've talked about it 100 times. Been back and forth on Chinese stocks. All right, so there's the good one. Let's go to the bad one. And remember, I talked about it last. I am cherry picking good with made money and bad with lost money, but that's not always the case. Maybe next time I'll try to find a trade where a good trade where I lost money. I think I was listening to I don't know how to pronounce the guy's name. Is it Qualmaggy or something? He has a bunch of videos on Twitter that people post. I like listening to the little snippets, and he said his best trade of the year. These are old videos. Maybe he has a paid room that these videos have gotten out to the internet because they're older, and so it's not as relevant. But he said GameStop was his best trade, and he lost like, I don't know, $5 million in it or some incredibly large number. And he said, that was my best trade this year. He says, because if I hadn't gotten out with $5 million loss, I'd have lost 30 million. So see what I mean? That's the idea. He followed his process. He took the loss, and it turned out to be his best trade. So this stock has been very tough. I've tried here, and I really was pressing the gas here because sometimes I like that third time's the charm. So it runs up, fake out, runs up, fake out. Third time is almost always the charm. And I don't know what happened. I don't know if there's news. I don't know anything, but honestly, that shouldn't matter. So when the stock quickly, when it should be going up and then quickly changes direction. So I think I was buying, I can't remember if this is this, okay, let's see, here's 818. And then this should be 819 right there. Yeah. So I was buying here the day before. I think this is Monday. And closed really well. It's in a pretty good sized position. And then it opened okay, pulled back, and then started to go again. And then I really pressed the gas and added to it. And then it just trapdoored. And I was like a deer in headlights. So no plan, no stop loss. Here's the 10-minute. So here I am buying it at $10.30. And, within 20 minutes, it's $9.30, which is, what's that percentage wise? Besides a lot, 9.8%. And it just happened so fast on me. And I didn't have a GTC stop loss like I should have, at least on some of it. A lot of times, let's say I have 10,000 shares. I like to have a stop loss on 2,500 of it. That way it triggers me emotionally, and in the back of in my mind, it triggers me, hey, something's wrong. My stop is gone off. And then if it's the low, like let's say that happens to me here. I have 10,000 shares and I get stopped on 2,500 and it comes back. Great, no problem. I still have 7,500. I'll just buy those 2,500 back there if I want. But this is what I'm trying to protect myself from, is this. And if I had a stop, maybe I get out at 2,500 there, and maybe I start thinking, wait, something's not right. So then I'm out of another 3,500 here, and then I finally can puke it all up here. And my average cost, although it hurts, is much, much better than where I finally did get out. So you have to build in contingencies with these stops on, like, it doesn't matter how the time frame. If you plan to get out of something at $10 a share, if that happens in 3 seconds, 3 minutes, 3 months, or 3 years, you're out at $10 a share. And I think it's harder when it happens so fast. But I'll be honest with you, this is a great example of when it happens that fast, all the more reason you want out. You want out quickly. Now, it did come back. Okay. But that's hindsight bias. The way it was acting, I was like, oh my, I felt there was a very fearful in my gut that maybe there's something really wrong with this stock. And what if I'm in it and they halt the thing? And then they're, so all my instinct is, I just got to get out at any price, at any cost, get out of it before they halt the thing. That's how bad it was acting. And so it held, and then it's come back. And now it's like I actually own it, but with a stop, a GTC stop, right? No, my stop's actually a little bit higher, maybe near 10 or something, because it was earlier, the stop was there, but I raised it near the end of the day. So that, it's interesting that, God, the shakeouts are brutal in this thing, and maybe I should just avoid this. It's not institutional quality, and so on and so forth. So this will probably be my last rodeo in it, regardless of what happens. But the main message is, if you're going to use mental stops, you gotta get into action immediately. And if you can't use mental stops, whether it's just a psychological thing, and most of the time I handle, 98% of the time I get out of my mental stops, no problem. I just, the way this acted, and the speed of it, I went into amateur hour and froze. So then you have a GTC stop with your broker. And sometimes I might have 5G. Let's say I'm worried about the liquidity. I don't want my brokers, I'm worried it's gonna come get my stock, right? You believe in that. That's fine. Whatever. We won't talk about whether that's true or not, but let's just pretend you believe in that. Okay, no problem. So then and you got 10,000 shares. So then you got 2,500 stop here, 2,500, 2,500, 2,500. Something like that. That's fine. You can do that. And I definitely do. I might have 2 stops on this, some at 10 and some a little bit lower. And like on half or 3/4 of the position, something like that. And then the rest I'll use a mental stop on. So the lesson here for the bad trade is, honor your stop. I don't care how fast it happens, whether it's 3 minutes or 3 days. And the faster your stop is hit, the more likely you want out. is my experience. So take the signal and run. Okay, so let's go to some stocks to watch. So I talked about Futu already. Acting great. Look at that earnings line. This is the only caveat. But China's been in a bear market for a long, long time. I mean, there's the peak of China. So that was in 21. If we go to a monthly, I mean, it's just done nothing for the longest time. So that, who knows? Maybe they can go into a bull market. C is the other stock that I own, International. And wasn't so worried about what the U.S. market was going to do. It's an international stock, and it's coming out of this base here, and you had the earnings out of the way. I did not own this into earnings. So I have been stocking this stock for a long, long time, but what's bothered me always about it was the lack of sponsorship. How come Fidelity Contra Fund? How come Duquesne Capital? How come XYZ Hedge Fund doesn't own it if it's so good? Because the earnings and sales are really, I mean, they're incredible across the bottom. These are tremendous numbers. And this was the catalyst for the gap here, which is I bought this day. I don't usually like to buy the gap days. I like to wait at least a day or two after. So I bought that day because finally now C has sponsorship. JP Morgan has a position that they just initiated. See, the dashes mean no position in the June quarter, 3 million shares. Fidelity Contra, no position, no position, no position, 90,000 shares or something like that. So this is my favorite, one of my favorite funds. They have a position. Duquesne Capital, Stanley Druckenmiller's family office, has a position now. So now I've got the sponsorship, and so I can own it with a little bit of confidence. And this is one of my, if not the biggest position I have because of the reduction in Futu. I think it probably passed it up. But coming into today, I had much more Futu than this one. But I did like a little bit of a swap today. I did some Futu selling and some C limited. I always call it C limited because that's what it used to be, but C buying. So acting well to those are two of the names. I guess I'll just deal with the stocks I own, right or wrong. I like Centrus Energy. This is a position. This is a shakeout buy. There's no real buy point here. Maybe this will turn out to be some kind of quasi high tide flag, although it's come off the highs much more than 20, 25%, like a textbook high tide flag would. But they're not all going to fit perfectly into some mathematical box for you. Wouldn't that be nice? So I love the group. I had some success with this stock previously. When it goes, it can really go. They announced a debt offering, which caused this gap down. Convertible debt, I believe, is what happened there. So that's a little bit, I'd like to see it get through here, and then I would start to increase my position. So I have a pilot or probing position as I like to call it, as we sit here today. And I think that would be it as far as the stocks that I'm long. I did have some shorts coming in, but I covered them today. So I was short like Palantir, which I covered 2 days ago, I think. And then some inverse ETFs like in MicroStrategy and stuff like that. Whereas MicroStrategy, I think it's going lower, but look, I'm swimming upstream. It's a bull market. I just don't see why fight it. The way Ethereum acted today, it just doesn't seem like it's worth the headache. So going into the weekend, the way everything closed so strong, my my experience would be Monday should be a good day, at least to start. It probably start out as a good day. How it ends, who knows? But if I decide to, I want that back, I'll just put it back on Monday. So you have MicroStrategy, you have Coin. This doesn't look very good. This looks kind of brokenish, but it's a really strong day. That's why it's so difficult to be short, because if you shorted Coin here, you got tested there, and then you thought, oh, I'm in good shape, and now you get tested today. Let's look at Palantir. There's nothing really wrong with that. It's pretty waterfallish. So let's see how it acts. It's the first time it's acted poorly in a while. So very extended. Let's see. NVIDIA. Did I do the ticker right? NVIDIA. I think it's a market stock. So it was up 1.72% today. And so I'm just going to guess that the NASDAQ was up 1.76% today. 1.89. So it's just going to do exactly what the market does, give or take a minute. Meta. So they had an AI hiring freeze, and I don't know if that caused the stock to go down a little bit in the last few days, but pretty good action today. And Meta's such a great company. It's maybe you don't want to own it, but I don't have any interest in shorting it. Tesla had a pretty good day too. Yeah, it was up 20. So this is very interesting. And Chris Kessel said something interesting on IBD Live that I really liked. He said, if I turned all this off, and just pretend you can't see any of that, right? And I just gave you this chart with these earnings and sales. You would just be like, well, why? What's the point to this? I mean, the relative strength's 58. Last few quarters are terrible to pedestrian. Now, LEU last quarter wasn't all that great either, but look at the relative strength. At least it's 99. Now the RS line has come off a little bit, but the RS is still holding up a little bit. So you just wouldn't be that interested in it. But maybe if it can get above here, if you absolutely adore Tesla, I would say wait for it to cross and hold above that line. All right, what else is out there that that I'm watching and I'm curious about? Hood, we got to look at Hood, of course. Holding up fine. That's a leader. I just don't have a huge watch list of like ideas. I don't know if that's the market. Let's look at CCJ. Holding up okay. What about Oklo? It's holding up okay. I mean, if you've held it a long time, you have a different strategy than I do, then I wouldn't blame you for staying the course in it. It's not done anything wrong. So I think I'm going to leave that just for the sake of brevity with for stocks to watch and give you guys one last one. MP. So it looked like it might have got a little support day there, but I'd rather it like LU on the weekly. So I prefer this is better, I think, because of the week. So I think MP might need some time, but this has very high tide flag feelish to it, and it's more in the parameters, but it didn't. I think it's actually down 40 cents today, which with the strength of the market. So you see, I have this trend line drawn, and I'll just stay the course, wait for something to happen to the upside like that. Okay, let's see here. Let me go to the virtual summit slide. So I need to jump to Google Meet. Let's see if I can pull this off. I use PowerPoint for this, but when we do presentations, we use Google Meet. All right. Hopefully you can see this. We'll see how this plays out. So this was a section that I did on Saturday in the virtual summit. And so I thought I would bring it back because I was going to steal some of the slides for mine and like, let's just do this whole section. Oh, you know what? It says I'm paused. Let me make sure I'm not paused. I'll mess this up. All right. So you should see risk management slide. Taking losses. So I talked a little bit about taking losses. I thought this was very interesting about retreat being a strategic maneuver, not a sign of weakness. You want to protect what you have. Like, you know, if you're in a wise general recognizes when to withdraw to regroup. I have horror stories of friends, unfortunately, that didn't protect what they had. And they allowed one stock or one market cycle or one this or one that to basically ruin them. And so then they didn't have any metaphorical ammunition to participate in the next move up. So that's the other thing about protecting yourself and in withdrawing or taking losses is it preserves what you have for what could be next. And sometimes what could be next is the same name, the same group, the same type of theme, but sometimes that theme changes. And so you have to be positioned to take advantage of it. This contrasts with the common perception of retreat as a defeat. So you want to stay in the game. Like I said, I've had friends that they didn't stay in the game, and it changed them, to be honest. I had one friend in particular who he just couldn't get over losing his account. It was very difficult to watch. So stay in the game, protect what you have. All stocks are speculative. All of them. Maybe some stocks are more speculative than others. I'll give you that. But every single stock is speculative. Don't kid yourself in thinking otherwise. Where are all the horse and buggy whip companies from the 1910s, 1920s, or whatever, the 1890s? They're all out of business. And the indexes do a great job of fixing this because they remove companies when they're not performing and add in new ones. So no matter what you own, they're all speculative. The math is cruel. The downside is, it just doesn't seem fair, but the downside is worse than the upside. So I think what's happening, this is just my 2 cents about the overall market structure, is I think everything happens so much faster now. So in the old days, this is a chart like the NASDAQ. And for whatever reason, it's so strange but that's like literally when I started my own personal account. March of 1995 is when I opened up my first personal trading account. I had started as a broker in 1994, and I got my first check where there was more than just surviving on food stamps. I still have one of my checks on the board up there where I made $400 for the month. Not the check, the pay stub. I had to cash the check. I couldn't afford not to cash it. But so I got a check for $5,000 and I put 3,500 of it in the market in March of 1995. And the market just went crazy. But then you had a 33% correction in the Asian crisis in 1998. And then you had almost the 80% tech wreck. And then the market went pretty well for a while, like 03 to 07-ish. And then you had the great financial crisis, minus 56%. So early in my career, I had these 3 really bad bear markets. But there was only 3 of them in what's that, a 15-year window. And then in the last kind of 15 years, I had 220s, a 24, 33, 38, and 27. So they seem to occur much faster, much more frequent, but they don't go down as much as as a general rule. And I don't know what that doesn't mean it can't change, but I think what I'm trying to say here is don't allow one of these periods to take you out, because guess what happened after every one of these periods? Really, really good and sometimes life-changing bull markets like Jim Rope will talk about after every one of these. And after the tariff kind of thing we went through, the market's been going gangbusters. This has been a great period since the April low of the market. So stay in the game, protect your capital so that you can participate in the next upswing. All stocks are speculative. So here's a comparison chart of AT&T to the S&P 500. 1999 is the start date. So 25-ish, 26-ish years. And in that time, AT&T's gone down 30% in that 26-year time period. Now, maybe you're even, or maybe even you're up a little bit with dividends. I didn't do the math nor care to. All I had to see was this is just raw returns, because the S&P has paid a dividend as well along the way, and the S&P's up fourfold in that time period. And the reason I chose AT&T is because it wasn't when I got in the business, I'd kind of missed that time period, but in the 70s and 80s, they used to call AT&T, or maybe even earlier, they would call it a widows and orphans stock. If you were a stockbroker and you had a widow or an orphan, you could buy AT&T for that client, and knowing that you've done your due diligence, you've done your duty as your fiduciary, so to speak, by putting them in such a quality company as AT&T. Things change. The math is cruel. Most of you probably know this, but it's you have to kind of see it sometimes. You know, it seems weird. Like, why should down 10%, I need 11 to make that back, but down 25, I need 33. And down 50, I need 100 to get that money back. So you can survive 10% pullbacks. You can, because making 11% is doable. Sometimes you can survive a 25% pullback. I don't like to come back off the highs on my account 25% if I can help it, because the 33% is a lot for a whole account, right? And 50%, you're just going to be swimming upstream for years. So these are strategies that you can use to protect yourself. You can manage an equity curve. You can use a stop loss, good till canceled. That's what GTC means. And I mentioned that with the quadruple U. You tell your broker, sell stop XYZ if it hits $8. Sell 1,000 shares if it hits $8. And that help protect you to the downside. Trimming winners into strength will definitely help. Sometimes it's no fun when you trim one and then it keeps going and going and going, but they don't all do that. And if you really love the name, then don't sell all of it, but you might want to do some trimming of them. So by managing an equity curve, this is my equity curve in July with some software I use. And you can see that bad break in April. What was that? That was Baba. I had a big position in Alibaba and it gapped down on me. I was buying off the 50-day and it gapped down through the 50-day. And so that bad break, I get into motion. I'm managing that curve. That looks bad. So I get really, really light. And then I'm very methodical in trying to build my cushion back up, even though I'm still up for the year at that point. The bad break is a signal to me that something's not right. Either it's me or the market or both. And then I want to methodically just try to build profits. And then once I get at or near the old highs, I can be a little bit more aggressive. So I watch this, and if I get a bad break again, I'm going to do the same thing again. And I always start every year at zero. So I start out methodically when the year starts out. You can see January to February, I'm just making very little progress. And then once I start to make a little progress, then I can put the gas on. And February, March, I was able to shoot up and build a cushion. So I always like to start at zero, even in my non-taxable accounts. I start, it doesn't mean I don't have any stocks. It just means that I'm going to manage that curve really closely. I'm going to be probably underinvested. I'm going to be quick to get out if something happens that I don't like, etc. So you could do this with an equity curve and a moving average. Like, so if you're the kind that's mostly fully invested all the time, you manage your equity curve, you put in a moving average, and then when your equity curve breaks below that moving average, you just stop trading. In other words, you're not adding to any stocks. You're not taking new signals until you get your equity curve to move back up through that moving average, and then you can go back to being aggressive again. So that's something you could do. And that's it. All right. So let me go back to the quote of the week. Judd Reese was on a podcast, and he was a fund-to-fund managers, and he was talking about hedge funds, because basically what he does, if I understood correctly, is he has a pool of money. Let's say it's $1 billion. ABC hedge fund, you get 80 million. XYZ hedge fund, you get 127 million. It's so on and so forth. So he's moving his money around, and he says they're too diversified. They're so concerned about losing money. They're too much. When you're managing other monies, you have other people's money. You have what I call career risk, and the career risk, because you have such a great career, is very real, and they overemphasize that career risk, it seems. We prefer our managers to have concentrated portfolios. Put it another way, we think a manager's fifth best position is more likely to produce strong results than his 55th position. So in this last handful of days, I really only had 2 or 3 longs. I had a really strong position, concentrated position in Futu. I had a medium position in C Limited. And then I had some ancillary stuff here and there, but mostly the rest is in cash. And in the type of stocks that you can find with the tools we have, with the strategy that we use, if you're using relative strength, you're using earnings and sales, you're using group strength, you're using sponsorship, those names, they move much faster than the overall market. So I could be 40, 50% invested and beat the pants off the market in a little window. Now it's tempting to say, well, I should have been 100%, but maybe I wouldn't have been able to handle it emotionally the correct way. So if you have a hard time being concentrated, then maybe just be concentrated in 50% of your portfolio and let the other 50% be mostly cash, earning interest, of course, or maybe smaller ancillary positions along the way. But you really want to build up that muscle to having concentration. All right. 800-831-2525. I don't have any idea how long this video was. Gosh, it might have been, I think it was 1:19 when I started. It is 2:08 Pacific time, so about 50 minutes. For those of you that stayed the course, I appreciate it. If you have any questions or comments, marketsurge@investors.com. Next week is Arnie and Harold, so please watch their video next Thursday. And I will have Friday off, and then I'll be back to you the following week. Have a great weekend. Thanks, everyone.